As you are wrapping up the tax season, you probably are looking towards the future. How can you save in taxes? Now, there are many opportunities that you have now to look forward to the future, and there are going to be some clear winners and some clear losers on how to save money on taxes in retirement in your future. Welcome. It's nice having you, and I really appreciate you taking the time with me today here to learn about 5 tax saving strategies for retirement and how that's going to benefit you in the future. Now, there are a lot of things that we will be discussing, and by no means is this an exhaustive list, but I do want to take some opportunities here to share with you some opportunities that you have to be looking to better yourself, better your family in the future, and these strategies are something that can really be beneficial. So let's dive into them. The 5 strategies that you need to be at least looking at for your retirement to make sure that you can be saving money on taxes going forward. Let's take a look at this. Opportunity number 1 to save taxes would be something you may already be doing. It's a Roth conversion. Now, what that looks like is that we take money from your IRA accounts or your 401k, your retirement accounts. Now, these are accounts that have never been taxed before. So we take money from them, and then we will be converting. So what means is paying some tax on that, and we're going to be putting it into your Roth IRA. Now, that is an incredible opportunity that you have because it's something that can grow tax-free. So we have tax-free growth, and then if you meet the certain conditions, you may be able to take that out of the Roth IRA tax-free as well. Incredible opportunities that you have to put money away today that can grow tax-free. Now, what is kind of about this here that makes it so beneficial? Well, it's the fact that, again, tax-free growth, yes, but it only works when taxes are going to go up. Now, what do we know? The Tax Cut and Jobs Act reduced taxes. They will be sunsetting here in a couple years, which means taxes by nature, by default, if Congress doesn't do anything, will increase. So there's a very good likelihood and a very small window that you have to significantly put money aside that can grow tax-free. And this provides a really good opportunity for yourself, provides a good opportunity for your family as well. Now, the one thing I want to let you know is to have a strategy here, because there's many times that people will be putting money aside into the Roths and it may be hurtful and it may not actually be impactful to help them. So that's where you need to have a strategy in place and look at the numbers, because we want to convert enough that's going to be beneficial, but not so much that it's going to actually put you in a bad spot tax-wise this year or maybe even next year to do all this. So taking a look at that, doing a Roth conversion, moving it from your IRA to a Roth so it can be tax-free in the future is an incredible opportunity, and that's the reason why I want that to be our number 1 spot. Second opportunity that you have is actually very similar, and it's something that is underutilized with many different individuals in their planning. That is life insurance. You see, when we take a look at life insurance, many of us have had the thought process that it's for income replacement while we're working, or making sure that our kids are taken care of when they're very young. Now, that's not the only opportunity that you have. You see, just like taking money out of your IRA account and putting it into the Roth IRA by way of a conversion, you can place money into life insurance as well. So yes, we have that death benefit that can go to your spouse, that can go to your kids, that can be left as a legacy to your community. So we have that aspect. But here's the actual nice benefit for what this means for you in retirement. you can take tax-free loans from the policy as well. So we can have the money be growing. We can actually have policies that can grow with the stock market. And we can take money out by loans. And this can be something that can be tax-free and be used for whatever means that you want. So it's not just one, it can be used for anything. Now that is an incredible opportunity to use a lot of different buckets for taxes. So we have a tax me now type of an account that would be stock, mutual funds, investments that are taxable every year that are not part of a retirement plan. You have a tax me later bucket. Now that's your retirement accounts. Those are accounts that no matter what that you're going to have to be taking money out of with required minimum distributions. I call those tax me later because no matter what, you will be taxed on those accounts at some point. And then the tax me never would be the Roth IRAs. We have also some of that life insurance money. And the more we can split between those three, the opportunity that you have to take money for retirement needs and purposes, we can reduce taxes. And that is an incredible opportunity that you have to plan for how and when you take your income in the future. Okay, so we have the Roth IRAs. Second, we have the life insurance. Third aspect that I want you to be looking at and considering, and this is for someone who is, maybe if you are not quite to Medicare age yet, maybe say you're maybe 60, 61, 62, and you're going to be coming up on Medicare, but you already have, say, a high deductible medical plan or a health plan. Well, we can do what's called an IRA to HSA rollover. So from an IRA, we can take money out of those accounts. And this is a once a lifetime opportunity that you have and your spouse has to take money out of your IRA tax free. So you're not going to be paying tax on it. You'll move it into the HSA, so your health savings account, tax free. And what do we know about the health savings account? We can put a good chunk of money in there for just some premiums for medical bills, but it's tax-free growth. And the second aspect is that when you take the money out of there, it's tax-free if it goes to medical related expenses. So that's basically a triple tax benefit. We get the tax benefit of not having to pay tax going from the IRA to the HSA. We get the benefit of the tax-free growth, and we get the benefit of taking the money out of there tax-free. An incredible opportunity that some of you have, especially based upon your age, to take money today, set aside for uses in the future that's tax-free. Okay, now we have the fourth aspect here. Now, you may be retiring, or you may have just retired over the last, say, year or so, and now you're going to want to take money out of your retirement accounts. You may even have company stock held in your 401k or some of your plans at work. And for many of you small business owners, this may be some stock that was maybe something that was privately held stock, or something that you have some good value gained in that stock that is an employer stock that you have. Now we can take that stock as part of the net unrealized appreciation tax laws. We can change that from ordinary income, because remember, any money that is in your retirement accounts, like an IRA, a traditional IRA account, a 401k, 403b account, a defined contribution plan, all of those monies are subject to tax. And that taxation is ordinary income. So whatever bracket you are in, that is the tax bracket that basically will be owed on that money. But we can take it as part of these tax laws, just the stock piece, and we can move it into that tax me now bucket, so that non-retirement bucket. And the best part about this we turn it from ordinary income into capital gains, capital income. So with the gains that you have in this stock, we now can be having capital gains, which either is a 0% tax rate, a 15% tax rate, or 20% tax rate, depending on your ordinary income buckets. But the best part about this is that it's cheaper. So you pay less tax than if we had kept it in your plan. So the net unrealized appreciation is a huge opportunity that you have. That's strategy number 4. Now let's recap here. We have Roth conversions, which is an essential piece to planning for, I would expect, all of you. The second opportunity that you have then is to use life insurance correctly in retirement, which is something that could benefit you. The third opportunity that you have would be to do an IRA to HSA rollover. Fourth opportunity that you have is to utilize the net unrealized appreciation tax laws to your benefit, especially when you're taking company stock out of your retirement plans. And the fifth and final way that you can save money on taxes, and a tax strategy that can be useful for not only you, but your family, is to do stretch IRAs. Now, what is a stretch IRA? First of all, this is for inherited IRA accounts. This is something, or inherited retirement accounts. So specifically, maybe you have received a retirement account from, say, your parents. They have passed, they have left you their accounts, and now you need to be taking money by law out of those retirement accounts. So we can't just set them aside and forget about them. But here's the thing. If you do nothing, you have a 5-year window that you need to take all of the money out of those retirement accounts that you inherited and pay tax on. Well, that's a huge strategy to increase your taxes, not decrease. So if we use the stretch IRA laws, what that says is that we can take that and extend that window, extend the period of time that you can be drawing money out of those accounts. So if we take a less out over a longer period of time, what that means is that you now have the ability to save on taxes and have growth happen in those accounts. Well, we can also be doing that with your retirement accounts that we leave to your children. So by just way of everything that we've been talking about here, if we leave these retirement accounts to your children, they're going to have that 5-year window as well. Now, if they choose to take and stretch that money over a period of time, now they have the ability to take less out of those accounts, pay less in tax, and have it continue to keep growing. So it's incredibly beneficial for your children as well as for you if you inherited these accounts as well. Now, I do want to give kind of a caveat here that the Secure Act of 2020, so right before the pandemic, it changed the terms of the stretch IRA. No longer can we go over your lifetime. Certain instances and certain individuals, they still have that option. But for the most part, it has kind of narrowed the time frame to a 10-year basically time period. So not 5 years, but 10 years to take money out of these accounts. So we take a less amount out, we grow the accounts, and we can take it out over 10 years. But here's a nice planning piece. Something you should really consider. Maybe we, instead of giving all of the money to your spouse upon your passing, maybe we give a little bit to the kids right now. So that money has a 10-year window on it that they will inherit, that they're going to be receiving and starting to have a 10-year window of when they have to be pulling money out of it and pay the taxes. The rest goes to your spouse. Well, then what we can do there is name the kids as the beneficiaries, and once your spouse passes and transfers the remaining portion to the kids, that's a new 10-year window. So now we have an incredible opportunity to save on taxes, stretch this money not just 5 years, but possibly 20 or more years that we can be employing for your children and making sure that the legacy that you leave for them is going to grow. There we go. 5 tax saving strategies, and this is something that all of you have the opportunity to look at with your own wealth, with your own savings plan, and it just amounts to some thought processes, putting together a process to look at the savings that you're going to have and make sure it's going to be beneficial. Now, it's not for everyone, I completely understand, but when we take a look at Roth conversions, that is something that you have an incredible window of opportunity now to make sure that it's something that you should or should not employ. The second one with life insurance, this is an opportunity that you have to put money away that can be used for obviously legacy purposes, but then also potentially be used for income purposes down the road. The third opportunity is a no-brainer. If you have a high deductible plan right now, you are not quite to Medicare age, do an IRA to HSA conversion, and you can put money away for medical expenses that will always be tax-free. Fourth aspect then, net unrealized appreciation. This is for you as the executive. Maybe in your organization you have a lot of stock options or stocks in your company stock in your plan, in your retirement plan. Maybe you as a business owner, you have an ESOP. All of these things could mean that you have a really potentially beneficial way to take money out of your account at a lot lower tax brackets in retirement. And then the fifth and final way that I want to be presenting to you to at least be taking a look at is to utilize the stretch IRA tax laws to your benefit. Now, these categories obviously are something that are, again, not exhaustive, but I definitely think you'll like it. For more tips, tricks, strategies for your wealth, please click this video right here, and we are going to go through more strategies on how you can be not only saving in taxes, how you can be putting a process in place for your wealth, and how you can make an impact for your community. Because I know your family, I know your company, and I know your community are vitally important to you. With that, take care.